Awesome Oscillator is a great momentum indicator that was developed by a trader called Bill Williams. The indicator can be used in many ways to build strategies, and in this video I will show you how to do that. First, let me explain to you how the oscillator works. The oscillator is built out of two moving averages. So you see here I have two moving averages, the green and the red. The green is the fast one, which is 5 periods, and the red is the slow one, which is 34 periods. And the histogram is the difference between the short and the long moving averages. And you can easily see when the short moving average cross above the long moving average, we have this crossover here. And when the opposite happens, we have this crossover here. So when the histogram above zero, we know that the short moving average is above the long moving average. And when the histogram is below zero, then we know that the short moving average is below the long moving average. And then the up and down in the histogram will calculate the distance between the short and the long moving averages. And in this indicator, we have extra information. So if we are above zero and the bar is red, that means the distance is less than the distance 1 bar ago. So when the distance is shrinking, the bars are red. And when the distance is increasing, then the bars are green. And it's the opposite below zero. So below zero, when the distance increases, the bars are red. And when the distance shrinks, the bars are green. So just like you saw, it's very simple. It's a momentum indicator. When we are above zero, basically we are moving up. And if the distance is increasing, that means we are moving faster on the way up. And it's the opposite on the way down. But in reality, the Awesome Oscillator is just a simplified version of MACD. So now we have Awesome Oscillator in the middle and the MACD at the bottom. And this is the same period. So MACD is 5 and 34. But of course, we can see it's not the same at all. And we can make MACD behave just like Awesome Oscillator by using the signal. So if I double click here, let me switch off the histogram and switch on the signal. So now we can see that the signal is very close matching to the histogram of the Awesome Oscillator, but it's still not the same. And the reason is Awesome Oscillator doesn't use the close for its calculation. In fact, it uses the median. And of course, we can mimic that here. So instead of using the close, we will use high-low close divided by 3. So that's 1. And then the other thing is this one using simple moving average. And we can change that also to a simple moving average. The only thing left is the smoothing part, because MACD uses a smoothing part for its average, and that one is 9. And if I switch this to 1, and now we can see we have exactly the Awesome Oscillator. Of course, I don't have the coloring rules here, but you can see it's exactly matching the Awesome Oscillator. So the Awesome Oscillator is just a simplified version of MACD. Now that we know what the indicator is, how it is calculated, and also that you can use MACD as an Awesome Oscillator by simply tweaking the indicator. So like all oscillators, we can use the crossing as the signal to get in. So when the histogram goes from negative to positive, meaning crossing 0, then we can use that as a signal to get in, to go long. And the opposite side, of course, to go short. Second methodology is we can use the distance between the two moving averages to get in and out. So the signal will be if after decreasing momentum, we face an increase in momentum, which is basically when the distance increase between the short and the long moving averages, then we can get in and we can exit on the opposite side. Also, you can use the same methodology in below zero. So for example, we can use when the momentum decrease between the short and the long moving average, but below zero, we can also enter long. So this will be a long signal and this is the exit. And of course, everything I said is the opposite for the short side. So these are the simple methods to use this indicator to build strategies. And I will show you how to do that in multi-charts. But also I'll show you how a data mining package like Strategy Quant X can come up with really unique ideas to build strategies using this indicator. First, let me show you the methods that I built to use this indicator. So this is multi-charts, and I built this awesome oscillator with the coloring. And this yellow line, it's an addition by me. It's a stochastic of this oscillator. It's just basically measuring when we have this reading here, how is it related to the past periods. Don't worry about the code. I have built the indicator and the strategy, and it will be available in StatOasis community. So basically we have the fast length and the slow length. These are fixed by the developer at 5 and 34. Of course, we don't need to stick to that. And then we have side, which is 1 for long and -1 for short. And then we have the methodology. So I have built 4 methods here, just like I explained. So here is now method 1. So going long only. Now, why long only? I'm using the S&P 500, and of course we know it's a drifting up instrument, but it's also a mean reversion instrument. And the interesting part is this is a momentum indicator. So theoretically, it should not work because, you know, the S&P 500 is a mean reverting instrument. So let me switch it on and let's see. So it's behaving correctly. You can see when we cross 0, it goes long, and when we cross on the opposite side, it exits. There's no short side because I disabled. And let's see what's the return of this strategy. So the strategy does make money. In fact, it makes $46,000 over the last, I think 13 years, let's see, since 2007. So yes, it has many losing years, but overall it's making money. And if we check the average trade is huge, 610. That's more than enough to cover everything. So how is this possible? I mean, I mentioned this on the channel a million times, that this instrument is a mean reverting strategy. How is it that we're making money by using momentum, and so easily, just by using the default parameters? And the trick is here. You can see here, the average number of bars in a trade is 34 bars. And I'm using here daily bars, so that should be 34 days. So you should always pay attention to these small things, because when you have an average bar in a trade of 34, that means sometimes you're holding this trades for 2 months. Now, since the S&P 500, it's a drifting up instrument, meaning all the indexes, the stocks, usually they drift up. Yes, they go in drawdowns. Yes, they face bear markets. But usually, most of the time, they're drifting up. So any strategy that holds enough bars, at the end of the day, they will make money. Of course, on the compromise is that you'll have big drawdowns. And you can see here that we're making $46,000, but our maximum drawdown is $63,000. So of course, that's huge, and you cannot use this strategy. So now I'm using method 2. And now this strategy is a losing strategy. So method 2 is when the price crosses 0, but we exit when the momentum drops down. And you can see here we drop down, we exit. So we enter here again above 0. Momentum drops down, we exit. And now we will test method number 3. So let me close this and let's see the performance of this one. So this one losing a little bit. Now method 3 is using stochastic. And final method 4, which is the momentum strategy. Basically, whenever the momentum decreases below 0, we go long, and we exit when the momentum decreases. So you can see here, it decreases, we go long. It decreases above 0, we exit. It decreases below 0, we go long. It increases below 0, we exit. So let's see, and this one is making money. It's making less money, and also a huge drawdown. So it looks like the default strategy is the best one. But now let me do a optimization. So we will optimize the fast length from 2 to 24, slow length from 25 to 100. And we will do the 4 methods. It's all going long. So we have 768 combinations. This should be very quick, and it is. And let's sort by net profit. So this is the methodology. So 1, 4, 1, 4, 1, 4. It's looked like it's split between 1 and 4. Here is the first 2, and this is at 229. So it's almost a third of the strategies, a third of the profitable strategies are between 1 and 4. But the difference is big. One, remember, is the original strategy, just a cross above 0 and below 0. And this is long only. So this is making 134,000. But look at the drawdown. The drawdown is 40,000. And also the number of trade. Number of trade is 29. And then the second one behind it is method 4. So we're making almost the same amount of money, but half the drawdown. And more than 3 times the number of trades. So definitely method 4 is much better than 1. And in fact, we can see easily that every time the number of trades is big, it's usually method 4. Not only we have too many trades, lower drawdown, good profits, but there is also another benefit in method 4. So let me apply it and show you. So if I go to trade analysis, look at this now. The average bars in trade is 11. Remember, we were around 33, so it's almost a third. So we cut our exposure to the market by 2/3. So instead of 33 bars on average, we are 11 bars on average in a trade. So overall, this is a much better strategy. And of course, we can see the curve is much better also. And remember, this is the S&P, and we are using momentum. And combining this strategy, a momentum strategy, with mean reversion strategy, of course, will yield you a much better portfolio. So this is very big idea that I keep pushing on you through this channel, which is building a portfolio of uncorrelated strategies. This is not, of course, magic or something that I discovered, but really this is one of the pillars of a successful trader, which is to build a portfolio of uncorrelated strategies. And those strategies, they don't have to be on different instruments. It's actually one of the best ways to diversify is through style first and then through the other things. The way I developed this is I came up with these 4 methods using stochastic, using momentum increase and decrease, and then my brain just shuts down and I think I came up with this. Now, the best part about a data mining package like Strategy Quant X is where even if you are not using it to automate and build strategies, if you just use it to find out other ideas and if an instrument is behaving well with this type of strategy or not. So let me show you how. So here we are in Strategy Quant X and I'm using TradeStation crude oil on daily bars. If we go to full settings, what to build, simple strategy, long only, random generation and conditions 1. So I just want 1 and I'll show you what I will pick. And then stop loss and profit target is not required. Nothing in trading option, and money management I'm using 1. And here is something to filter the strategies. I'm going to build only 20 strategies because I want to show you how the style of the strategy paired with the instrument affect the generations of strategies. So I'm looking for 1.3 profit factor for the whole data. That means I'm looking for a profitable strategy. Stability is the curve. So that means it's, moving up nicely. I'm looking for at least $100 per trade and number of trades 65 minimum. And if we go to building blocks, so let's shrink this. So I picked only Awesome Oscillator. You can see here I picked Awesome Oscillator, everything in it. So when it changes direction, above level, below level, falling, rising, higher than a level, lower than a level. And then I picked Awesome Oscillator here in the indicator section, plus all the operators. So lower, equal, greater than, cross above, falling, blah, blah, blah. I picked all type of orders and exit after number of bars to be used. So it's either Awesome Oscillator or exit after number of bars. So I'm limiting the platform to build a strategy only using Awesome Oscillator basically, because I'm looking for more ideas. I'm gonna run this in real time. So let's see how fast it come up with 20 strategies matching our ranking. So that's fairly quick. So the project finished in 5 seconds. We can see we have multiple strategies making good money, but of course some of them have big stagnation period. It doesn't matter. I'm just looking at how fast we can find profitable strategies. Now let's switch to the short side. So same crude oil, same everything. Let me clear this. and let's see how long this will take. Okay, so this like 0 second. So it's so much faster building short only on crude using momentum. This tells you something. This tells you that crude oil behave very well with momentum strategies on the short side, although it was working on the long side. But 20 strategies, it almost took 0 seconds. Now, I'm not saying all these strategies are good or robust. I'm just saying like how fast it is. And this gives you a great look inside the instrument behavior. So let's clear all this, and now let's switch the data to natural gas. So this is natural gas, and we are going short only. And let's clear, and let's see how fast. Again, this is in real time, and again, almost 0 second. So natural gas, short only, behaves very well with momentum. I mean, it took 0 seconds to find a strategy using a momentum indicator only. Remember, all these are single condition, and we can check this. If we go to source code, pseudocode, let's look at the entry. Awesome Oscillator is falling for 4 bars. That's it. It's one condition using Awesome Oscillator to enter. All these. So this one is rising. This one is rising for 2 bars. This one is falling for 3 bars. Rising for 4 bars, and so on and so forth. Okay, let's clear this. And now let's go long side natural gas using same everything. So clear log, and let's start again real time. So we see how natural gas was 0 second to develop 20 strategies on the short side. On the long side, I'm running this real time, and that's why I'm talking. It's not finding any strategy. So I'm gonna stop talking and fast forward. Let's see how long it takes to find profitable strategy. Okay, here we are around 5 minutes later, and 1.5 million rejected strategies. You can see we didn't get any strategies. And if we look at the detail of why we didn't get any strategies, so no trades about 1 million, so that's 60%. But no profitability, or profitability is less than 1.3, the profit factor, is 40%. So it couldn't find a strategy that is making a 1.3 profit factor. This concept also I'm pushing very hard on the channel, which is marrying the right style of strategy to the right instrument. So just like we saw in natural gas, now of course this is not a be-all rule, but it really gonna help you a lot to align the type of strategy to the instrument. And just like we saw now, the natural gas, momentum long is hard to build. Of course, we are using only the Awesome Oscillator. If you use other things, it might work beautifully. But for simplicity, it's long momentum on natural gas is a lot harder than short, because it took 0 second to come up with 20 profitable strategies, and it took 5 minutes to come up with 0 strategies on the long side. And if you take that principle and apply it in your development, which of course I teach in my Algo Trading Masterclass, how to find which instrument is better suited for what style, then you'll find it's a lot easier to find robust strategies on that instrument. So I followed that principle, and I built about 11 strategies, I think, on the indexes and 3 futures market. So this is, for example, on the ES, the long side, and this is the equity line, and this is the ES on the short side. Here is the portfolio of the indexes. The 2008 is a down year, again in 2011, 2015, and then COVID, and just recently. Now I will take the index portfolio and I will add 2 strategies on gold. One is long, one is short. Of course, all using the oscillator. And we can see we enhanced the profitability and we kept the drawdown almost the same. Now I will add natural gas on the short side. Again, much better portfolio. And finally, I will add 2 crude oil strategies, one long, one short, again using only Awesome Oscillator. I want to show you that you can always decrease the drawdown and increase the profitability and make a better equity curve by using a portfolio of uncorrelated strategies. And this is how the portfolio behaved. You can see, so forget the drawdown percentage because all this is based on the $10,000 starting capital, which is of course not real. But look at the trades. So the ES long 385, but the short side is 65. And the EW 74, NQ 185, and gold long is 157, gold short is 72. Crude oil is almost the same between long and short. So we see we have 1,500 trades on multiple markets using a single indicator. And all these strategies are either falling for number of bars or rising for number of bars or below level or above level. They're all using Awesome Oscillator. Of course, none of these strategies are robust. I didn't run any robustness test. I mean, they might be, but I didn't run any robustness test on them. I just want to convey the principle of uncorrelated strategies. To learn more, make sure to watch this video and I will see you there.